Hello champions, I have a super ambitious target in this video, and that is to give you an extreme level of confidence in very less time on all the 5 exemption sections of capital gains. At the end you will tell me whether we met our target or not, okay? I've kept the table blank. We will fill it in together. Wherever you're sitting, no matter which part of the country you're watching this video from, wherever you're sitting, you will try to keep saying the answers out loud along with the video. Okay, let's see how many of these points we get them right. All right, you will tell me out of these 5 sections which of these 5 sections you got perfectly right, beginning to the end. Let's take it as a challenge. Let's see how nicely we have learned the capital gains chapter. Okay, come on, tell me. Section 54, your first exemption section. Who is the assessee? Here the assessee has to be either an individual or a HUF, guys. And what kind of capital gains are we talking about? Only long-term capital gains we're talking about. In section 54, what are you transferring? What is a capital asset you're transferring? You're transferring a residential house property which should be assessed to tax under IFHP, which means it should not be under construction and all. Also, it should not be assessed under PGPP also. It should be a residential house property assessed under IFHP. Okay. Then comes a new point. What is a new asset that you're buying under section 54? Under section 54, either you should be buying or you should be constructing one residential house property in India. But however, you know, right, over here there's an exception, guys. What is the exception? Come on, tell me. Let's put an orange star over here. What is the exception? The exception is that once in the lifetime of the assessee, once in the lifetime, if LTCG happens to be within 2 crores, very good, then in that case we can take exemption for 2 residential house properties in India also, right? Generally the limit is 1 residential house property in India, but once in the lifetime of the assessee, if LTCG is within 2 crores, then exemption can be availed for 2 residential house properties in India also. Okay, then what is the time limit? Under section 54, you should buy the new asset or you should construct the new asset within how much time? It depends. Are you buying or are you constructing? If you're buying, you should buy either 1 year before the transfer, or you should buy within 2 years after transfer, or and if you're constructing, you must complete the construction within 3 years from the date of transfer. So we have 3 time limits over here. If you're buying the new asset, you should buy it 1 year before transfer or within 2 years after transfer. If you're constructing the new asset, you must complete the construction within 3 years from the date of transfer. Okay. Then maximum, how much exemption do you get under section 54? You do have a maximum limit over here. The maximum limit is 10 crore, guys. This is a maximum exemption which you can enjoy under 54. Will the CGD concept apply? Will the capital gains deposit account concept apply over here? Yes. What will be the lock-in period? The new asset which you are buying, you have to keep it with yourself. You should not sell it within 3 years. 3 years will be a lock-in period. In this 3 years, what you should not do, in this 3 years, you should not sell away the new asset. What will happen if you sell the new asset? If you sell the new asset, then in that case you will have capital gains, guys. You're selling away the new house, right? So you will have capital gains. To compute capital gains, you need cost of acquisition of this new house. So from the cost of acquisition, you will subtract whatever exemption you have enjoyed. From the cost of acquisition, you will subtract the exemption which you have enjoyed. In other words, you will attack the cost of acquisition. You understood the last part? I'll repeat the last part again. In case in the lock-in period of 3 years, in case you happen to sell away this new asset, if you're selling away a new asset, you will have capital gains. To compute capital gains, you need cost of acquisition. So from the cost of acquisition, we will subtract whatever section 54 exemption you have enjoyed. That will become your revised cost of acquisition. That revised cost of acquisition only you will index and all. Okay, so this was it about section 54, guys. Understood? So assessee, come on, tell me one last time. Who is the assessee? Individual or HUF? What kind of capital gains? Long term. What are we transferring? Residential house property assessed under IFHP. We can sell how many of our houses? No limit on how many houses we are selling. But how many houses can we buy? Only one residential house property, that too in India. But however, once in the lifetime, if LTCG is not more than 2 crores, then we can take exemption for 2 houses also. Then what's the time limit? If you're buying the new house, we must buy 1 year before transfer or 2 years after transfer. If you're constructing the new house, we must complete the construction within 2 years from the date of transfer. Are you noticing all the time limits are from the date of transfer? Okay. Maximum exemption is going to be 10 crores. CGD concept will apply. A CGD concept I will explain to you towards the end. Lock-in period is going to be 3 years, which means in these 3 years, you should not sell away the new asset. What will happen if you sell away the new asset? Then you will attack the cost of acquisition. The cost of acquisition of the new asset, from that you will subtract whatever exemption you have already enjoyed. Okay. Whatever exemption you have enjoyed under section 54 will be reduced from the cost of acquisition. Got it? So can I say one exemption section done, guys? Yes, I hope you got it right. Let's see if you can get section 54B correct. Okay, now under section 54B, who is the assessee? Here the assessee happens to be either an individual or a HUF. What kind of capital gains are we talking about? It can be any kind of capital gains, guys, long term or short term, doesn't matter. But what is the asset we are transferring? We are transferring over here an urban agricultural land which has been used for the last 2 years for agricultural purposes. It should be an urban agricultural land which has been used for agricultural purposes at least for the last 2 years. Either the individual or his parents or HUF, they must use the agricultural land for agricultural purposes for at least minimum the last 2 years. Okay, then what is the new asset that we are buying? The new asset we are buying is either an urban agricultural land or it is a rural agricultural land. What's the time limit? Within how much time are we buying this new land? Within 2 years. All time limits from the date of transfer, guys. Within 2 years from the date of transfer. Then maximum exemption, how much will you get over here? No maximum limit over here. CGT concept will apply here also. Lock-in period here also will be 3 years. In 3 years, what you should not do? In 3 years, you should not sell away the new land which you have bought. And what will happen if you sell it off within 3 years? Same thing, guys. If you're selling away the new land, you will have capital gains computation. To compute capital gains, you need cost of acquisition. I will attack the cost of acquisition. From the cost of acquisition of the new land, I will subtract whatever exemption I had enjoyed. But even over here, guys, I have a small catch for you, and that is this 3 years lock-in period concept will not apply to which asset? See, if the new asset happens to be urban agricultural land, then the 3 years lock-in period will apply. But if the new asset happens to be a rural agricultural land, then in that case, this 3 years lock-in period concept will not apply, because even if I sell it within 3 years, I will anyways not do any capital gains computation for rural agricultural land, guys. It is not a capital asset. So there is no question of attacking cost of acquisition and all, right? So therefore, to rural agricultural land, 3 years lock-in period will not apply. It's a loophole. Even if I sell it with rural agricultural land during the 3 years, still there will be no implications on me. There will be no tax implications at all. Okay. So this was section 54B, guys. I am an individual or a HUF. I'm having any kind of capital gains. It can be long term or it can be short term. It doesn't matter. I am transferring an urban agricultural land which has been used for agricultural purposes at least for the last 2 years, and the new asset which I am buying is an urban agricultural land or a rural agricultural land. I am buying it within 2 years from the date of transfer. No maximum exemption limit over here. CGT concept will apply. Lock-in period is 3 years. In 3 years, I should not sell away the new asset. If I sell, I will attack the cost of acquisition. From the cost of acquisition, I will subtract whatever exemption I have enjoyed. Okay. Now come to section 54D. In section 54D, the most unique point is that the assessee over here can be any kind of assessee, doesn't matter. Here, capital gains can be any kind of capital gains, long term, short term, doesn't matter. Here, however, what is a capital asset you're transferring? You're transferring a land or a building which was used for industrial purposes for same thing, at least for the last 2 years. Minimum for the last 2 years, this land should have been used for this land or building should have been used for industrial purposes. The most unique point, one more unique point about section 54D is that section 54D will apply only and only if the transfer is by way of compulsory acquisition. Understanding? If the transfer is in any other manner, 54D will not apply. Section 54D will apply only if the transfer of the land or building which was used for industrial purposes was by way of compulsory acquisition. Only then section 54D will apply. Okay. What is a new asset that you are acquiring under 54D? Same thing, you are acquiring another land or building which you are going to be using for industrial purposes. Okay, within how much time are you supposed to acquire this new asset? You're supposed to acquire this new asset within 3 years. But 3 years from the date of when? Not from the 3 years from the date of transfer, guys. It is compulsory acquisition case. So in compulsory acquisition cases, when do you tax the capital gains? You tax the capital gains only when you receive the compensation or part thereof. So the 3 years time limit you will compute from the date on which you receive the compensation or part thereof. Okay, here also no maximum exemption limit. CGT concept will apply here also. Lock-in period over here also is 3 years. Same thing, in these 3 years you should not sell away the new asset. If you sell away the new asset within 3 years, then same thing, I will attack the cost of acquisition. From the cost of acquisition of the new asset, I will subtract whatever exemption you have already enjoyed. Okay, so this was section 54D. The most unique point is that the section will apply only and only if the transfer is by way of compulsory acquisition. Only then this section will even apply. Okay, so and then after this we learned assessee can be any assessee, capital gains can be any capital gains, long term or short term. We are transferring a land or building which was used for industrial purposes for the minimum last 2 years, and the new asset that we are buying is a land or building which we are going to use for industrial purpose. We should buy this new land or building within 3 years, but not from the date of transfer. In 54D, we are transferring by way of compulsory acquisition, right? In compulsory acquisition cases, the taxation is only when we receive the compensation or part thereof. So only from that day, only from the point of taxation, only once we receive the compensation, from that time only the time limit of 3 years will start. Okay, no maximum exemption. CGD concept will apply here also. Lock-in period 3 years. In 3 years, you should not sell away the new asset. In case you sell the new asset, I will attack the cost of acquisition. Easy. Right, guys? Now, come on, let's go to our fourth section, which is section 54EC. Just a moment, somebody's come. And listen, guys, so in 54EC, who is the assessee? Here also the assessee can be any person, doesn't matter. Can be company also, can be individual also, can be any person, doesn't matter. But here the capital gains should be long-term capital gains only, not short-term, only long-term capital gains. We are transferring any immovable property. It can be land, it can be building, it can be a warehouse, it can be any immovable property we are transferring. And what are we buying? We are buying bonds. What kind of bonds? 4 bonds we're talking about. What are the 4 bonds? I'll put it for you over here. The 4 bonds are Rural Electrification Corporation of India, then National Highway Authority of India, then PFCI, Power Finance Corporation of India, and then IRFC, which is Indian Railway Finance Corporation. So we are buying bonds of REC or NHAI or PFCI or IRFC. Within how much time are we supposed to buy the bonds? Within 6 months from the date of transfer, we are supposed to buy the bonds. Then maximum exemption, here we do have maximum exemption limit of 50 lakh rupees. The CGD concept will not apply in 54EC. Lock-in period, unique point, guys. Lock-in period is 5 years in 54EC. One more unique point in 54EC, in the lock-in period of 5 years, what you should not do? You should not do 2 things. You should not sell away the bonds also. You should not convert the bonds into money, which means you should not pledge the bonds with the money lender and get a loan against the bonds. Even that is not allowed. So during the lock-in period, you should neither sell away the bonds nor you should convert it into money. You should not pledge it. Okay. In case there is a violation, now we will not attack the cost of acquisition. Instead, whatever 54EC exemption you had enjoyed, we will simply reverse the exemption. Understanding? So under section 54EC, assessee can be any assessee. The capital gains will be long-term capital gains only. The capital asset transferred will be immovable property. The new asset that we are buying should be bonds. The time limit, you should be buying these bonds within 6 months from the date of transfer. Maximum exemption here is 50 lakhs. CGD concept will not apply over here. Here the most unique point is that lock-in period is 5 years, and in these 5 years you should neither sell nor you should pledge. This pledging point is not there anywhere else, only in 54EC. Everywhere else 3 years, only over here 5 years. Okay, and in case you violate, that is during these 5 years, if you sell away the bonds or if you pledge the bonds, then whatever 54EC exemption you have enjoyed, we will reverse the exemption, which means in the year of violation, we will tax that exemption which you had enjoyed earlier. We'll tax that exemption now as capital gains, as LTCG. Okay, then comes your last exemption section, guys, which is section 54F. Now in 54F, here the assessee has to be an individual or HUF. Only long-term capital gains only we are talking about. Assessee has transferred any long-term capital asset other than residential house property. Any other long-term capital asset assessee can transfer. The new asset which the assessee is buying is one residential house property in India. Now even over here, can I say that like section 54, can I say once in the lifetime you can buy 2 houses also, provided LTCG is within 2 crores? No. All that drama is not over here. In 54F, simple. You should be buying one residential house property in India. Story over. You never have the option of buying 2 houses under 54F. Okay. What's the time limit? Same thing like section 54, guys. If you're buying the new house, you should buy it 1 year before transfer or within 2 years after transfer. If you're constructing the new house, you must complete the construction within 3 years from the date of transfer. Okay. Now coming to the next point, maximum exemption. This is unique. 54F. F for formula. We have a formula over here, and the formula for section 54F exemption is amount invested in the new asset into LTCG by net consideration. Right, guys? Are you understanding? Are you listening? So under section 54F, how much maximum exemption you get? Amount invested into LTCG by net consideration, that is proportionate exemption you get over here. But you have to be careful when you're doing this computation. Okay, this amount invested number, this can be maximum 10 crores only. If it is more than 10 crores, you will restrict it to 10 crores. Okay. So under section 54F, the maximum exemption is on the basis of a formula. The formula is amount invested into LTCG by net consideration. And also remember that this amount invested should not be more than 10 crore, maximum 10 crores. All right. Now there's one more point in section 54F, and that is on the date of transfer, of the long-term capital asset, whichever assessee is transferring, on the date of transfer, the assessee can own maximum one residential house property only. Basically, if I ignore this new asset which the assessee is buying, ignoring this new asset, on the date of transfer, the assessee should be having maximum one residential house property only, ignoring the new residential house property. So ignoring the new one, on the date of transfer, assessee can have maximum one another residential house property only. Okay. Here also the CGD account concept will apply. Lock-in period is 3 years only. In 3 years, what you should not do? You should not sell away the new house. What will happen if you sell away the new house? I will not attack the cost of acquisition, guys. In 54EC and in 54F, we will reverse the exemption, which means whatever exemption you had enjoyed earlier, we will now tax it as long-term capital gains. Okay. So this was section 54F. Assessee is an individual or HUF, and the capital gains are long-term capital gains, and the capital asset that you're transferring can be any long-term capital asset, just that it should not be residential house property. The new asset that you're buying is one residential house property in India. You never have the option of buying two houses ever over here. Time limit will be dependent on whether you're buying the new house or whether you're constructing the new house. If you're buying the new house, you must buy it 1 year before transfer or 2 years after transfer. If you are constructing the new house, you must complete the construction within 3 years from the date of transfer. Okay. The maximum exemption that you can enjoy is on the basis of formula. In the formula, amount invested should not be more than 10 crore. CGD concept will apply. Lock-in period will be 3 years. In 3 years, you should not sell away the new house. And in case you do sell within 3 years, in case you violate the lock-in period, then whatever exemption you had enjoyed earlier, it will now be reversed. It will now be taxed as long-term capital gains. Okay, so this was your entire discussion of all the 5 sections. But listen to me, the story is not over. Just 2 to 3 last few points, guys. See, point number 1, generally if you see all the, one second. Generally, if you see, all the time limits are from which date? All the time limits are from the date of transfer. Okay, but you have 4 situations, right, where the point of taxation is different. Like, that is, in compulsory acquisition cases, you tax the capital gains only when you receive the compensation, only upon receipt of compensation or part thereof. Then in your liquidation cases, you tax the capital gains only upon distribution of the asset, guys. Then in your conversion of capital asset into stock in trade, here you tax the capital gains only upon the sale of stock in trade. And lastly, in insurance compensation cases, you tax the capital gains only when you receive the compensation. So in these 4 cases, the point of taxation is different, right? Generally, we tax the capital gains whenever we transfer the capital asset, but in these 4 cases, the point of taxation is different. So in these 4 cases, all the time limits will be computed from the point of taxation. Like in 54D, compulsory acquisition, so the time limit will be computed not from the date of compulsory acquisition. The time limit will be computed from the date of receipt of compensation. Understanding? Let's say one of these cases involves a conversion of capital asset into stock in trade. So the time limit will be computed not from the date of the conversion, not from the date of transfer. Instead, the time limit will be computed from the date of sale of stock in trade. Understanding? So generally all time limits are from the date of transfer, but in these 4 exceptional cases, all the time limits will be from the point of taxation and not from the date of transfer. This was one extra point I wanted to tell you. Second extra point is about CGD, guys. See, when does CGD come into the picture? I'll tell you. Okay, see, in case you want to get the new asset, you have in all the 5 exemption sections, you're buying some new asset, right? The new asset, if you want to buy, you have to buy it within the time limit. Now, if you buy the new asset within the time limit of 2 years, 3 years, 6 months, whatever is applicable, if you buy the new asset within the time limit, and if you also buy it within the earlier date, I'll tell you what the earlier date is, okay? If you buy it within the time limit, also within the earlier date, then in that case, CGD concept itself will not apply. But however, if you buy the new asset within the time limit, but if you buy it after the earlier date, then in that case, you have to put the money into CGD account, only then you will get the exemption. Alright, now what is the earlier date? Earlier date is nothing but whatever is your applicable 139(1) date, or when did you actually file the ITR, whichever is earlier. Alright, generally in the examination they don't tell you when did the assessee file the ITR, so you will end up taking the 139 1 date itself, but actually it is 139 1 date or when did you actually file the ITR, whichever is earlier. So if you buy the new asset within the applicable time limit of 2 years, 3 years, 6 months, whatever, and you also buy within the earlier date, then no CGD concept itself. But if you want to buy the new asset after this earlier date, then you have to put the money into CGD account. Whatever money you put into CGD account, that concept, that much amount only you will get as exemption under the section, under the respective section. Okay, but one more thing, remember, like for example, let's say your assessee, his 139 1 date was, let's say, 31st July 2025. Okay, he put money in CGD account. Let's say he put 1 lakh rupees into CGD account and he put this money on 1st of August 2025. So in this case you will not get any exemption, guys. No exemption, because if you are putting the money in CGD account, you should put the money within the earlier date. So within 31st July 2025 you should have put the money, only then I would have considered. Any money you put in the CGD account after the earlier date, I will ignore. Okay, so first of all, when does CGD concept come into the picture? It comes into the picture with when you want to buy the new asset after the earlier date, then you have to put the money into CGD account. But when you should put the money in CGD account, you should put the money in CGD account within the earlier date. Okay, if you put the money inside this account after the earlier date, then in that case you will not get any exemption. And once you put the money in CGD account, you must ensure you utilize the money, whatever is this time limit. No, within the time limit you must utilize the money. If you don't utilize the money, then once this time limit is over, we will revisit the CGD account. We will see how much money is still left in the CGD account. Whatever money is still left in the CGD account, that much amount will be taxed as capital gains of the year in which this time limit is over. Like let's say, for example, let's say your date of transfer was the 25th of March 2025. Okay, now let's say 2 years time limit. Let's say we're talking about 54B, 2 years time limit is applicable. So in that case, we will come back and check the CGD account on 25th March 2027. We'll see on this date how much money is still there in the account. So whatever money is still there in the account, that will now be taxed as capital gains of which year? In this year. When is the 2 years period getting over? Previous year 26-27. So in 26-27, whatever amount is remaining unutilized is going to be taxed. Okay, so I've tried giving you a brief revision, a quick revision of the CGD concept also. But, and did you notice even over here, all the time limits are from which date? From the date of transfer only. Only in these 4 exceptional cases, when the taxation is different, only in these 4 cases only, all time limits will be from the point of taxation. Okay, but don't forget, the CGD concept will not apply in 54EC, which means in section 54EC, only this option you have. You don't have the CGD concept. So in section 54EC, you should buy the new asset not only within the time limit, you must also buy within the earlier date. But remember, this unique point is only for section 54EC. In all the other exemption sections, CGD concept will apply. Only in 54EC only it will not apply. Alright guys, so this was your master summary of all your capital gains exemption sections. I hope you've noticed in 54, 54B, 54F, assessee can be individual or HUF, but in 54D, 54EC, assessee can be any assessee. In all the other sections, the transfer can be in whatever mode, but in 54D, it should be only and only by way of compulsory acquisition. In 54B and 54D, the capital gains can be any kind of capital gains. In the other exemption sections, they should be long-term capital gains only. In 54 and in 54EC, only you have the maximum limit for exemption. In 54F, it's a formula based exemption. Here the amount invested should not be more than 10 crore. CGD concept will apply everywhere except in 54EC. Everywhere lock-in period is 3 years. Only in 54EC, only lock-in period is 5 years. Everywhere else in the lock-in period, you should not sell away the new asset. But in 54EC alone, you should neither sell nor you should pledge the new asset. In the first 3 sections, if you violate the lock-in period, then you will attack the cost of acquisition. From the cost of acquisition, we will subtract whatever exemption you've enjoyed. But in the last 2 sections, in 54EC and 54F, here if you violate the lock-in period, we will not attack the cost of acquisition. Instead, we will reverse the exemption, which means how much ever exemption you had enjoyed earlier, it will now be taxed. In the year of violation, now it will be taxed as if it is capital gains. Okay, I am hoping you're confident, feeling a little better with the exemption sections, guys. I'll close over here. Do let me know in the comment section below if this was even one bit helpful for you. Thank you, guys. Bye-bye.